Aggregate demand refers to the total demand for goods and services within an economy during a specific period. It represents the combined spending power of consumers, businesses, government, and international trade. Now, we will delve into the components of aggregate demand, and its relationship with the key economic indicators. Aggregate demand comprises several components. The first one is consumer spending, which is the largest component of aggregate demand. It represents the spending by households on goods and services, ranging from daily necessities to luxury items. Consumer spending is influenced by factors such as personal income, savings, borrowing, and consumer confidence. It plays a significant role in driving economic growth and is a key indicator of consumer sentiment. The second component is business investment. This includes spending by businesses on capital goods, such as machinery, equipment, and infrastructure, as well as R&D activities. Business investment is driven by factors such as expected profitability, interest rates, technological advancements, and market conditions. It has a direct impact on productivity, innovation, and long-term economic growth. The third component is government expenditure. It refers to the spending by the government on public goods and services, including infrastructure development, defense, education, healthcare, and social welfare programs. Government expenditure is influenced by fiscal policies, such as government budgets and policy priorities. It can be used as a tool to stimulate economic activity during downturns or to address societal needs. The last component is net exports, which represents the difference between a country's exports and imports. It indicates the contribution of international trade to aggregate demand. Positive net exports, also known as a trade surplus, occur when a country exports more goods and services than it imports. Negative net exports, or a trade deficit, occur when imports exceed exports. International factors such as exchange rates, trade agreements, and global economic conditions influence net exports. Now, we will explore the key factors that influence aggregate demand in an economy. Consumer behavior and spending patterns play a crucial role in shaping aggregate demand. Factors such as consumer confidence, income levels, employment rates, and changes in wealth influence the willingness and ability of consumers to spend. During periods of high consumer confidence and disposable income, consumers tend to increase their spending, driving up aggregate demand. Conversely, during economic downturns or uncertain times, consumers may reduce their spending, leading to a decrease in aggregate demand. Business investment decisions significantly impact aggregate demand. Businesses assess various factors, including expected profitability, market conditions, technological advancements, and government policies, before making investment decisions. When businesses are optimistic about profitability, they are more likely to invest in capital goods, research and development, and expansion plans. Increased business investment stimulates economic activity and boosts aggregate demand. Government fiscal policies, including taxation and government spending, have a substantial impact on aggregate demand. Governments can use fiscal policies to influence the overall level of economic activity. Expansionary fiscal policies, such as tax cuts or increased government spending, can stimulate aggregate demand by injecting money into the economy. Conversely, contractionary fiscal policies, such as tax hikes or reduced government spending, may dampen aggregate demand. Global economic conditions and trade dynamics have a significant influence on aggregate demand. International factors, such as exchange rates, trade agreements, and economic conditions in other countries, affect a nation's exports and imports, thereby impacting aggregate demand. When global economies are thriving, demand for exports increases, positively impacting aggregate demand. However, economic downturns or trade tensions can lead to a decrease in exports and negatively affect aggregate demand. Now, we will explore the relationship between aggregate demand and key economic indicators. Aggregate demand has a significant influence on key economic indicators such as GDP, inflation, and employment levels. Aggregate demand directly affects GDP as it represents the total spending on these goods and services. When aggregate demand increases, businesses produce more goods and services to meet the demand, leading to economic expansion and a rise in GDP. Conversely, a decrease in aggregate demand can lead to reduced production and a decline in GDP. Aggregate demand can exert upward pressure on prices, contributing to inflationary pressures. When aggregate demand exceeds the economy's capacity to produce, demand pull inflation may occur, as businesses raise prices to match the increased demand. On the other hand, when aggregate demand is low, prices may decrease, leading to deflationary pressures. Aggregate demand also has a direct impact on employment levels within an economy. When aggregate demand increases, businesses often need to hire more workers to meet the higher production requirements. Higher aggregate demand creates job opportunities, reduces unemployment rates, and contributes to overall economic growth. Conversely, a decrease in aggregate demand can lead to job losses and higher unemployment rates. Thank you for joining us today as we explored the power of aggregate demand and its role in shaping our economy. Remember, a deep understanding of aggregate demand can lead to informed decision-making and contribute to a robust and resilient economic future. Goodbye, and until next time.